In February of this year, one of the top hedge fund managers on Wall Street, Ray Dalio of Bridgewater, who has billions of assets under management, and by anyone's definition is one of the economic elites in the U.S., wrote a 30-page paper talking about past inflationary and deflationary financial panics, along with some commentary on why they happened. In this paper, that I encourage Goldseek Radio listeners to read, because your economic well-being could hinge upon understanding exactly what this means going forward, Dalio outlines a blueprint for what the U.S. should do differently from the past and do what he calls a quote-unquote beautiful deleveraging. Dalio is mainstream educated, and one can tell this from reading his paper with an obvious Keynesian background, because he thinks of deflation as this evil boogeyman that ruins everyone, and he also has this obvious Keynesian perception that deflation is the problem and not the cure. Dalio suggests the Federal Reserve implement specific monetary policy measures going forward to avoid the too extreme fat tail bimodal events. One of the events is a highly deflationary free market forces debt destruction, and the other event is a runaway Weimar Republic-style hyperinflation. Dalio lays out a blueprint for central bankers at the Fed and central planners to follow to keep the markets and the economy in the middle of these two extremes, involving a combination of policy measures that combine uses of financial repression and the wealth effect, which are measures the Fed has used in the past. The middle of these two extremes is, for all intents and purposes, an attempt at controlling a tolerable degree of stagflation, which attempts to produce an increasing inflation rate through nominal GDP targeting, debt monetization, and buying up toxic assets off bank balance sheets and giving the banks fresh new capital injections, followed by cooling off periods or disinflation periods like the one we are in now, where the Fed waits for commodity prices to drastically drop before implementing the next round of stimulus. All of these measures fit in well with the already mentioned financial repression, which is negative real interest rates combined with other policy measures to force banks, pension funds, and even individuals in their 401ks and IRAs to buy and hold more sovereign debt. Would you be happy if you were suddenly forced by law to hold 5% of your assets in U.S. Treasuries if you knew they were not going to keep up with the real inflation rate, and you also knew they were not getting a real return high enough so you could eventually retire? This is no joke, as financial repression was forced on Japanese citizens, pension funds, and corporations, and for over 2 decades many Japanese citizens have not had any real investment returns, and now many middle-aged workers there have not been able to generate any investing income for a long time, making retirement near impossible. Unfortunately, this plan will also lead to worsening misallocations of capital and resources and higher real unemployment rates, because price signals will be ignored or just avoided entirely. This plan will also guarantee greater control over markets and the economy by the federal government, special interest groups, Wall Street, and large corporations. While Mr. Dalio's plan is great for the politicians in D.C. and the large banks and hedge funds of Wall Street who benefit from inflation and are more financially prepared to deal with inflation, it will no doubt continue to make the real economy worse on Main Street. Unfortunately, academics like Carmen Reinhart and Kenneth Rogoff, authors of This Time is Different, 8 Centuries of Financial Folly, and Wall Street elites and money managers like Ray Dalio, are going to be the experts and thought leaders who people at the Federal Reserve listen to for policy suggestions and advice. That means Ray Dalio's blueprint will have very good odds of being implemented by the Federal Reserve going forward. In my opinion, it will mean a declining standard of living for most that live and work on Main Street in the United States and in other countries who cannot properly adapt to what the Federal Reserve is doing. In conclusion, Ray Dalio's beautiful deleveraging would only be beautiful for D.C., Wall Street, and the other rent-seeking parasites that directly benefit from both those two major groups gaining more control of our capital markets and our economy. Ray Dalio is a brilliant money manager with an amazing track record for producing fantastic returns, but he has laid out a plan for central planners to gain even more top-down control of markets and the real economy in the U.S., and that only people with capital or a financial education similar to his would benefit from. This is the world we all live in, and Goldseek Radio listeners are going to have to adapt their investing portfolios and their lifestyles to the possibility that this plan is indeed implemented. Finally, I would like to provide Goldseek Radio listeners with a quick update on the success of Petro Profit Report and why they should strongly consider buying themselves a reference copy, because over the next few years this report will prove to be money well spent. Despite oil prices still consolidating in a trading range recently and having gone down over the last 9 months, in the 1 month since the Petroprofit report came out, purchasers of the Petroprofit report have already gotten gains of around 40% on 2 separate companies featured in the report in just the last month. It's not easy to pick winning stocks in a down market, but the research team at Wall Street for Main Street has a history of doing exactly this, as we also picked out one of the top performing gold stocks that is up a lot in the last 18 months despite gold's long correction and consolidation. For more insights and research into capital markets and the real economy through our free market lens, please check out our Petroprofit report at petroprofit.com and our main Wall Street for Main Street website at wallstformainst.com.